Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Friday, April 15th, 2022. Today, the market is closed because of Good Friday, so I'm doing my weekend update podcast a little bit early. Usually I do it on Saturdays, but thank you for coming today. I hope you're having a good day. I hope you had a good trading week. Hope life is good, and just appreciate you being here. So thank you very much. So this is the plan for today. This is the format of the podcast. First of all, we're going to take a look at all of my daily setups and trades that I took last week. We're going to talk about when I bought them, why I bought them, how I'm going to manage them going forward. I have some open trades still. I have some closed trades that I did close out last week on the daily time frame, so we'll take a look at those. Also have some open trades on the weekly time frame. We're going to take a look at when I bought them, why I bought them, how I'm managing those going forward, and then I do have also a trade on the monthly. Just as a reminder, I do like to trade multiple time frames. I feel like it smooths out your equity curve, so that's why during the regular trading day, I do day trade all day long on generally a 5-minute chart. I take my trades also on the daily charts, take them on the weekly charts, take them on the monthly charts, just so I have some diversification in my time frames that I'm trading. In addition to trading multiple time frames, I also like to trade multiple different type of setups of strategies, not just one. And I feel like that helps to smooth out your equity curve as well, and you're not reliant upon just one type of different trade, because stocks sometimes are in uptrend, sometimes they're in downtrend, sometimes they're going sideways, and you have to have approaches and strategies to use in different time frames, because the market does different things. And then lastly, in addition to the multiple time frames, multiple trading strategies, I also like to trade as many different types of markets as possible. I like to get outside of equities, trade metals, bonds, silver, the dollar. And so I've been trading for 25 years, and using those three kind of variations of different time frames, different strategies, and different markets, I believe is the key to my trading success. So anyway, after we take a look at my current positions on the multiple time frames, we're going to talk a little bit about trader psychology. Trader psychology is the most important component of trading. Being able to create a plan, follow your plan, is a skill, just like it's a skill to learn about technical analysis, support, resistance levels, entries, exits, overhead resistance levels, support levels below, trailing stop methodologies. You do have to learn all of this. It is important. It's not that hard. It takes some time, but that's only one half of the equation. Once you've learned the technicals of trading, and so that you can create a plan. After you've created the plan, you have to instigate the plan and follow the plan. It's kind of like losing weight. If we want to lose weight, we pretty much know how to do it, right? We exercise more, we eat better foods. It works, right? But it's hard to do because there's the emotional aspect involved in eating, and it's the same with trading. So yeah, being able to pick your spots, get in the entry, position size correctly, all very important, but can you do it? That's the key point. So I like to spend some time on this podcast talking about trading psychology, because it really is the most important part of trading. And the longer you've been trading, the more you know that this is true. So we'll spend a few minutes and we'll talk about trader psychology. After that, I do have a great trading poem from my trading poet friend, Frank. We'll go over that. He always writes a poem every day. It's relevant to what's happening in the market, and I always think it's a nice little time to highlight one of his poems. When I used to do the live stream every day, he would come on in person and I would read his poem, and I miss that. Frank, if you're listening, miss that, buddy, but I do like to cover this at least on the weekend podcast. All right, after that, I have gone down through my watch list already, just a little bit of a time saver compared to what I did last week, but I have already gone down through my entire watch list. I've gone down through the stocks one by one, and I have already marked some potentials for next week, and that's part of this podcast. I like to go through what I'm looking at for next week, some potential levels, Generally, the markets have to go up or they have to go down from where they currently are before I'll get interested. But I think I have 15 symbols that I've already gone through, analyzed, and these are setups that I will be interested in for next week. And hopefully that helps you by watching this take a look at how I look at levels, what I'm looking at, and hopefully that's helpful for you as well to learn. All right, and so that's going to be the podcast for today. I do, excuse me, I'm losing my voice a little bit. I do have to run the U.S. legal disclaimer before we get started, so hang tight, and I'll be back in 40 seconds. Thanks a lot. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. All right, thanks for holding on with me through that. Let's take a look at the daily trades. GLD. This is a current open trade that I have, and let's get into why I bought this. I did buy this back on January, February, March, April 8th with this 520 crossover. And, you know, a lot of people use crossovers. I've mentioned this many times on this podcast, but my favorite crossovers, the ones that I have found in my experience that work the best, are the ones that have sideways motion or consolidation prior to the crossover and that also happen inside the value zone. The value zone here, this is the top of the value zone, the 1 ATR. The green line here below, this is the -1 ATR. ATR stands for average true range. But anywhere below this green line, anywhere above this green line, I consider to be in value. And you know, I studied one-on-one with Dr. Alexander Elder, and the one concept that he really tried to put into my brain is you need to buy in value and sell above value. Conversely, you can buy below value and sell in value. And a lot of you know about the deep dip buy approaches that I use. Well, deep dip buys are going to be way below the -1 ATR channel, so that's going to be buying below value. Generally, if it gets into the value zone, I will sell it because some price action will dictate that I do that. Sometimes it will go right through the value zone and keep going up. But in general, buying below value, selling in value. Buying in value, selling above value. What a lot of amateur traders do is when things are going well, they buy when it's well above value. That's generally when I'm selling it. And then if they buy above value and it comes back to value, that's generally where they get stopped out. And that's generally where I want to add again. Doesn't always work out. Sometimes stocks go plenty above value and keep going. But, you know, as traders, we're playing a probability game, and the probabilities are when we get up to like the third ATR channel, here's the first, here's the second, here's the third. Probability states that if we get up to this third ATR channel, about 92% of prices tend to stop going up and or go down. So why would I want to buy up at the third ATR channel if 92% of the time that's the case? So anyway, I say all of that because on this gold trade, like I said, I like to have sideways motion prior to a crossover, and I like to be at least below value or in value when that happens, so that if it moves up, I can start selling in above value. Well, here we go. Here's the 520 crossover that happened on 4/8/22. Before that happened, we had the sideways motion in the value zone. I bought this at 181.45, moved up right away, straight away, didn't even have a hiccup down, which kind of trades I like, obviously, so bought at 181.45. You can see this orange line up here. You might ask, what's that? That is 1.5 ATR value above my entry. So my entry was here at 181.45. As soon as it gets 1.5 ATRs above my entry, that's when I go into what I call trailing stop mode. I've moved far enough. I've moved 1.5 ATRs from my entry, so I've moved outside of noise. Whenever I have a trade, and regardless of whether I'm trading deep dip buys, crossovers, higher low V1s, V2s, it's the same. As soon as it moves 1.5 ATRs from my entry, then if I have a close below the previous day's low, I will get out of half, because it's a bit of a red flag. I mean, obviously, if the price were to come all the way back down, it would probably have to start with some kind of close below the previous day's low. So that's why. So we entered here, 520 crossover, got up to my trailing stop level 184.50, and then on Thursday, yesterday, we had a close below the previous day's low after reaching the 1.5 ATR trailing stop level. So I did go ahead and lock in half of my position at that point. So I got out of one half position at 184.02, still have half the position, locked in profit 1.42%. Now we're at 59.18 RSI. Soon as we start getting up into the 65 RSI level, then I'll go into a different trailing stop mode where I will use a close below the 5 EMA. I'll get out of the rest of the position. Alternatively, it could just keep going up above 65 RSI, and if it gets up to a 70 RSI and then rejects that, and what I mean by that, intraday it goes above 70 and closes below 70, or it closes above 70 and then maybe in the coming days it closes back below 70, I will get out of another half of the half position that I have, and then if I get another close below the previous day's low after that, I will exit the position. But really nice setup here, has worked out well. Again, 520 crossover in the value zone, moved up beautifully, got to 1.5 ATR trailing stop level. Now on Thursday, had a close below the previous day's low at 184.02 for a profit of 1.42%. So still have half of this position and doing well. All right, that's my only open daily position. These are the closed positions, or in other words, most likely these are the positions that did not work. So I did buy Google on Wednesday on the 13th of April. I was waiting very patiently for this trade setup. Here we have the 200. Here we have the 250. Here we have the 300 SMA. Well, we sliced right through the 200-day moving average. We sliced right through the 250-day moving average. We sliced right through the 300 moving average. And then the day that I bought it, on the 13th, the reason I bought it is we had a close below the 300 and then a close above the 300. And the reason I was waiting for that particular setup was, if we look in the past, you can see right here, last time we were at the 300, we bounced beautifully. Last time, and then the time after that, we had a close under, close back over the 300, huge rally, right? So I like to look in the past to see whether or not the moving average that I'm keying off of, in this case, the 300-day moving average, whether or not it has had support in the past. And it did have support here. It did have support here in the past. And that's why I was hopeful that it would hold this time. Well, it didn't. The formal reason I got into this, again, was a close below the 300, close back above the 300. We also closed below the negative third ATR channel, close back above. Remember, 92% of prices when they get to the negative third ATR channel also hold. So that's why I really like this setup, because we went under 300, over 300, under the negative third, over the negative third, and we also had a V2. A V2 consists of 3 bars, where bar 1 you have the low, bar 2 goes below day 1's low by at least a quarter ATR, and then the third day closes above day 1's close. These are all important levels. And in trading, one of the ways that you can really put the odds in your favor is looking for a combination or a confluence of many different signals. It helps to increase your odds. Well, here we go. Close under 300, over 300. Under negative third, over the negative third, plus a V2. really, really nice setup. But unfortunately, no matter how many combinations or confluences of indicators that you have lining up, doesn't mean it's going to be a profitable trade. And this one was not a profitable trade. I bought it at 26.0507. My end of day stop was a close below the 300-day moving average, and on Thursday it closed well below for a 2.8% loss. And I talked earlier about trader psychology and how important it is. I think a lot of people could talk themselves into looking at Google and going, well, I don't know if I want to sell it because it is super low. But look, I'm a professional trader. I have to abide by my rules. And the reason I got into the trade was to close under the 300, over the 300. It closed back under. I just have to get out. Now, Monday, it could close back over the 300. I might take another shot at it, right? Or it could go lower and into the 30 RSI level. That would be my next level to the downside. So generally, whenever I'm looking at stock setups, I'm looking for the stock to go higher or lower. So on Google for next week, and when we get to the stocks that interest me for next week, we'll go over this again. But Google, if it goes higher and closes back over the 300, I'll get in again. If I'm wrong, I'll probably be wrong small if I'm doing the right position size and have the right level. So if it closes back up above the 300 SMA, that's where I'll be interested. Conversely, if it goes under 30 and over 30, that will be my next level to the downside. So this was a losing trade, 2.8% on Google. MS, which is Morgan Stanley. I bought this back on April 7th. And why did I buy this? Well, another confluence of signals. Intraday, we went under 30, over 30 in the same day. That's the main driving buy signal. But I also want confluences. Was there another confluence? There was. There was an intraday rejection of the negative third ATR channel. Remember, 92% of prices tend to stop going down, go sideways, or go up. And this, you can see, it's exactly what happened. So under 30, over 30, rejection of the negative third ATR channel, plus a V1. Here's day one. Here's day two. Day two goes below day one. Day two goes below day one. Day two closes above day one's close. During these podcasts, I generally don't have time to get into the nitty gritties of the approaches like the V1s and V2s. But if you go to my YouTube channel, there's a lessons playlist there, and there is a link for V1s and V2s. V1s and V2s are great indicators. They're great entry triggers to get you into a trade as long as the big picture context of the trade is all in line. And so I do have a video there. It's totally free. Go and watch it. I love V1s, V2s. They're a big part of my trading. They're the bread and butter of my trading. And the reason they're so good is because it shows you that there's a rejection of a previous low, that the market already rejected it and closed back above. It doesn't mean it can't go back down after, but it does increase your chances that the market already tested it before you were in the position and reversed back up. But it reversed back up over key positions. It rejected the 30 RSI. It rejected the negative third ATR channel. V1s, V2s happen all the time. You just can't take them randomly, but you have to take them at levels that have support, like major moving averages, third ATR channels, low 30 RSI. So anyway, I bought this here, 83.10. It moved up, and then I got out on the 13th. Why did I get out on the 13th? Well, I never hold through earnings. I believe it's a total gamble. Even if a company has nice earnings, sometimes you see the stock go down. Sometimes you see a stock have bad earnings and go up. So I don't like to hold through earnings. I really do consider it a gamble. So whenever there's earnings, I get out prior to the earnings and just lock in my current gain or my current loss. So this fortunately was a gain of 1.32%. Got in at 83.10, got out at 84. Yeah, exactly $1. 83.10 to 84.10. Then earnings came out and I peaked. I went, I wonder if it went up or down. Oh, they went up. Well, it gapped up. They had decent earnings, or at least the market thought they had decent earnings. Gapped up, went higher, came back down. It was up 0.78%. But as traders, our number one responsibility is to manage risk. It's not to make money, it's to manage risk. And if you manage the risk, the money will come. But if you focus on the money, the losses come. I don't know how to explain it. It's just how it works. And so my job as a money manager is to get out prior to earnings, because putting myself in front of earnings, holding through earnings, I'm just gambling. I mean, that's one of the quickest and fastest ways to lose a lot of money immediately. Of course, yes, it's one of the ways that you can make a lot of money as well. But again, our job as traders is to manage risk, not put ourselves in front of a freight train, a potential freight train that could run us over, and holding through earnings is what does that. So I did get out, got in 83.10, out at 84.10 for a 1.32% gain, got out prior to earnings, and it went up, but that's just how it goes. It could have gone down 10% as well. So locked in a nice, decent little gain there. So that's all for the dailies. Let's head over to the weekly trades. So I did buy Facebook on the weekly. Another confluence of signal here, everyone. Most of the trades that you would see me take will have confluences. What was the first signal? The main driving signal on the weekly. And by the way, weekly bars close on Friday. Usually they closed on Thursday yesterday because it was because of Good Friday. But the main driving reason here was a confluence. The main driving reason was the under 30, over 30 from week to week, and then under 300 SMA, over 300 SMA. Those are the two driving factors. But in addition to that, we also had some other nice things. We had a close back over the negative third ATR channel. Remember, 92% prices fell there. And we also undercut the low over here. So it was a false breakout to the downside from this range. We had a V2. We have an under 30, over 30. We have an under 300, over 300. Lots of signals, lots of confluences of signals there. So I bought here at 26.01. Right now it's 216.01. Excuse me. I bought at 216.01. Right now it's at 210.18. So I am slightly underwater. However, part of my trading is, we've talked mainly about stops, getting out, managing risk. Haven't talked a lot about profits, but the risk part, the downside part, the trailing stops, emergency stops, end of day stops, these are all defensive moves. Taking partial profits to the upside when the market provides them to you is what I call offensive. And anybody that knows sports knows that you have to play both offense and defense in sports. And my offense comes from taking partial profits when the market gives them to me. What I do is I take the closing price of whatever I'm using. I take the value of the 0.45 ATR. In this case right now it's 11.05. So for Facebook, I would take the current price. I would add 11.05 to it. That would be my first profit target for next week. I take the first profit target for next week, again add the value of the 0.45 ATR, 11.05. That would be my second, and then I'll do it again for the third. So there were profit targets that I did hit here at profitable levels, and it came back down. So I'm really glad I did take a portion off. I usually take 10% of whatever I have off at each profit level. They really add up over the years, and then if you do get a pullback, then I would get out, and I've mitigated part of the loss because I took part of the profits at higher levels. Okay, so anyway, signal, close under, close over 300 SMA, under, over 30 RSI, false breakout to the downside, V2, 26.01. My end of bar stop on this particular trade would be a close below the 300 SMA. Right now it's 207.48. We're at 210.18. So if next week, if it goes below, I'm not going to do anything until it closes below, or if it hit my emergency stop here. If it hits my emergency stop, I always get out immediately. No ifs, ands, or buts. But I am only going to hit my 2 ATR emergency stop about 5% of the time. 95% of the time, my stop will be just to close under my end of day stop, and my end of day stop here is the 300 SMA. So a little bit down on the trade. Let's take a look and see. Down 2.7% on the trade, but again, not really down that much because I took partial profits on the weeks where it went up, but still down on the trade. Now, we have earnings here. coming on the 27th of April. And you might ask, well, Greg, this is not a daily trade, it's a weekly trade. Do you hold through earnings then? No, I don't. It doesn't matter if it's a monthly trade, doesn't matter if it's a weekly trade, doesn't matter if it's a daily trade. I will get out prior to earnings. Just go ahead, get out. And the market's going to do what it's going to do. It's either going to go up or go down, but I don't want to put myself in front of that freight train by holding through earnings. So slightly down on this trade, 2.73%. IWM. I've been in this trade for a while, and generally what you're going to see, everyone, is if you take a trade that's working for you, you're going to be in it a long time. If you're trading correctly, you're going to be in it a long time. If you take a trade that doesn't work for you, you're going to get out very, very quickly. Just like the Google trade. I got in one day, next day went against me, boom, out. Well, this trade on IWM, which is the Russell 2000, I have been in this for 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3. I've been in this trade for 3 months because it's working, and I don't want to mess with it because if it's working, why do I want to mess with it? Unless it gets to certain levels. So I did buy IWM back here on January 28th, 2022. Why did I buy it? Well, confluence of signals. Under 30, over 30. Rejection of the negative third ATR channel again, and throw cherry on top, we also rejected the 100-day moving average. So I bought here 193.20 with the confluence of signals. Of course, I have my trailing stop level up here, 1.5 ATRs above my entry. Where is my end of day stop on this trade? My end of day stop on this trade is a close below 30 because that's why I took the trade in the first place. Under 30, over 30. So if it were to close back under, it would untrigger the reason I got in, but it has not done that. So got in 193.20, moved all the way around. I was up on the trade, down on the trade, but it kept closing above the 30 RSI, so I kept the trade. Then we got up to trailing stop level here, which I'm at. And then we had an over 50 RSI, under 50 RSI. Now, whenever that happens on an under 30, over 30 trade, I'm going to take half my position off, which is what I did. And so I locked in a profit here at 208.43 because we went above 50 RSI and below 50 RSI. Just to point out, you may think, I'm not following all these kind of things, but I just do want you to know that I do teach private one-on-one lessons in the evening time via Skype. I teach all 5 of the different trading approaches that I use. I teach my students step by step. If you're interested, just email me. I'll talk about it again at the end of the course. At the end of the podcast, we'll talk about it more specifically. But if you're interested in becoming a trader, interested in learning how I trade, I think the best way to learn anything is one-on-one with a student, with the teacher and the student, and that's why I provide the lessons in this format. And we get into all the nitty-gritties, all the entries, exits, profit targets, all that kind of stuff. So keep that in mind. So under 30, over 30, rejection to the negative third ATR channel. We rejected the 50 SMA up, 50 RSI up here. That's why I exited, locked in at 208.43. The first half was approximately, this is approximation, but the first half gain on this trade was about 7.15%. Have given some back, but again, you can see the trailing stop methodologies up here of why I got out really helped to add to the profit of this trade by locking in those gains. What we have remaining on the remaining half is up 2.78%. And then again, of course, as the market moves up a certain percentage, for me, it's the value of the 0.45 ATRs, I take partial profits. So throughout this trade, I took some profits here, I took some profits here, I definitely took profits there, took some more profits up there in addition to getting out of half. So I always set my emergency stops, I set my end of day stops, I set my trailing stop levels above. There are certain levels that if they get to, I'll take off half. There are certain levels that they get to, I'll take off everything. And then of course, as the stock moves up or the market that I'm trading moves up, I always take partial profits. And that's the combination of using good setups, good risk to reward ratios, position sizing correctly based upon volatility, and then incorporating your trailing stop rules. So it's not that easy, right? I mean, there's a lot of things going on here. It's difficult. It's difficult to be a trader. I mean, a large majority of people who trade lose money. So you have to do what a lot of other people are not doing. And that is the devil's in the details here of the stops, the position sizing, the trailings, the taking partial profits. So, there's a whole thing to trading, right? There's a lot to it, and that's why a lot of people don't succeed. But, if you do want to learn to succeed in trading, you want to learn this skill, contact me. We'll set up the one-on-one lesson. So the remaining portion here up 2.78% in addition to the half that I locked in. IBB. All right, so I did take a new trade on IBB on yesterday, because Thursday was the last day of the week yesterday because of Good Friday. I want to go through this entire trade with you of how I position size, what I'm doing, but let's first take a look at what the signal was. Well, way back here on the 18th, we had a close under, close back over the 200. That would have been a legitimate entry with your end of week stop being a close below the 200, which it did. So you would have gotten in and gotten right back out for a small loss. Well, then we closed back above. Then we held above. The reason that I took this trade on Thursday was I like that it came back, it checked back and had an intraday rejection of the 200-day moving average. An intraday rejection just means it went below it at some point of the week and then closed back above it. This is a little bit of a pullback to the 200, so it's more of a test compared to just to close under and close back over from a lower low, which they don't tend to work out as many times as you would think. Higher lows tend to work out much in much higher numbers, and that's why I bought this trade. So I bought this trade on yesterday, 131.01. Now, when I buy, let's just go through this. So when I identify the trade that I want to take, first I have to look at the technicals. Yes, there I have it. After that, I'm like, okay, I am going to buy this. I have to figure out how many shares I'm going to buy. So I mention this each week, but it is really important because I don't see a lot of people position sizing based upon the current market volatility, but using the value of the 2 ATR will really help you do that. But the first thing you need to do after you've identified your trade entry, you have to decide how many shares am I going to buy. So this is a general rule, but it's a good rule. Whatever your trading capital is, let's just say it's $100,000. I will risk 1% of my total trading capital on any particular trade in the worst case scenario. Most of the time, that worst case scenario is not going to come true because of how far I put my stops away. But in the worst possible case scenario, if the stock gets down to my emergency stop, I know exactly how much I'm going to lose. And generally, 1% is a good idea. So if you have $100,000 capital in your account, 1% of that's $1,000. If you have a $50,000 account, 1% of that is $500. If you have a $25,000 account, 1% of that is $250. So for this example, let's just say I have a $100,000 trading account. 1% of that's my maximum allowed loss. So I would take, in that particular situation, $1,000. I then divide it by the value of the 2 ATR. And the 2 ATR means that it's taking the average range of the last 20 days, adding that all up, dividing it by 20. That will give you the 1 ATR. But and then timesing that by 2 gives you the 2 ATR. It puts your emergency stop 2 ATRs away from your entry. It should not get down there. If it does, something's really bad and you need to get out right away. So again, $100,000, 1% of that's $1,000. Take that, divide it by the value of the 2 ATR. The value of the 2 ATR here is 1501. So I take the $1,000 divided by 15.01. That tells me to buy 66.6 shares. So I would just round that up to 67 shares. So now I'm position sizing based upon that volatility. So now that I entered, I know how many shares to buy. What's the first thing I need to do? Well, I need to place my emergency stop. And how far away do I do that? Well, I take my entry price minus the value of the 2 ATR, which is 1501, and that's my emergency stop. So if you go $15.01 times 67 shares, you're going to have the $1,000. See? So that's my emergency stop. Where's my end of day stop on this trade? My end of day stop is a weekly close below the 200. So if it closed below the 200 next week, I would get out. Would I lose $1,000? No, because I only lose $1,000 if it gets down to this level. So that's why I'm saying only about 5% of the time will you ever hit your emergency stop. Most of the time there'll be smaller losses with a close below your end of day stop. So my end of day stop here is a close below the 200-day moving average. Now that's to the downside, right? We always want to look at downside risk first. Emergency stop, 2 ATRs below, end of day stop, close below the 200-day or 200-week moving average. And now finally to the upside, what is the orange line? The orange line is 1.5 ATRs, which is 1125 above my entry. If it goes up there, then what happens? That's right, I go into trailing stop mode. All right, so I identified the setup. This is a high or low intraday rejection of the 200-day moving average. I took my maximum allowed loss. I divided by the value of the 2 ATRs. That tells me how many shares to buy. I place my emergency stop below, which is, again, just the value of the 2 ATR. That's my emergency stop. If it got down there, I get out. Doesn't matter if it's in the middle of the week. I generally wait till the close of the bar to make the decision, but not if I have an emergency stop. With emergency stop, that's my line in the sand. If it gets to that dollar amount, I'm done. I don't care. And so here's the emergency stop. End of day stops close below the 200-day moving average. Also put my trailing stop level above. Now I have a complete plan, right? We talked a little bit about scaling out in profits. So let's just do this. I'll just show you real quickly because this is in real time. I take the price, 130.86, and I add the value of the 0.45 ATRs. In this case, it's 3.38. So my first profit target on this particular trade is going to be 134.24. And what did I do again? I just took the value of the closing price. I look over at what the 0.45 ATR value is. It's 3.38. So I take the closing price plus 3.38. That gives me my first profit target, 134.24. That's my first profit target. I take the first profit target, add again the 338 in this case. Second profit target's 137.62. Then I take the second profit target, add again the value, 3.38. Last profit target is going to be 141. So let's just go ahead here, put these lines here because this is a new trade. So this is a good time to do this. So my first profit target was 134.24. My second profit target was 137.62. And third profit target is 141 even. So this is a weekly trade, so I'll put these in here good till canceled. So here we have a complete trading plan, right? High or low rejection of the 200-day moving average, position size correctly, put our emergency stop, end of day stops closed below the 200-day moving average. What are the three lines up here? Those are my profit targets. How much am I going to get out if I hit my profit targets? Well, let's just say, what was I can't remember. So let's just say it was 100 shares, right? So 100 shares, 10% of whatever I currently have at the moment is where I'm going to get out with my profit target. So if I have 100 shares right now, I'm going to put a limit order in for 10%. 10% of 100 is 10. So I'm going to put a limit order in for 134.24 for 10 shares, limit order in for 137.62 for 10 shares, limit order at 141 for 10 shares. And then when the week's over, I'll do it all again. If I did it on the daily, I do it every single day and move my profit targets. All right, so that is the new trade that I just took on Friday. I really do like the setup. We'll see. Hope it goes up, hope it hits some profit targets, hope it gets to my trailing stop level, obviously, but if it doesn't, close below the 200, I get out, or my emergency stop. So that's the new trade on IBB. All right, Disney. Do have a closed trade on Disney, and this is a good example of looking at the levels, entering the trade, position sizing, doing everything we're supposed to do. It didn't work out, but it was a small loss. So last week, we had an intra-week rejection of the 250-day moving average, right? You can see in the past it did hold the 250-day moving average well, so I was hopeful that it would also, but this week it didn't. But what did I do? I took that hypothetical $1,000, I divided it by the value of the 2 ATR. That told me how many shares to buy. I bought, I placed my emergency stop. Again, how far below? 2 ATRs below. That's my emergency stop. If it got down there, I would have lost how much? You're right, $1,000. My end of day stop, end of week stop in this case would just simply be a close below the 250, giving me a very good risk to reward ratio. Place the 1.5 above there. How did it turn out? And I placed my profit targets too, my 3 profit targets. Did it work out? It did not. You can see we closed below the 250-day moving average slightly. So it was a very small loss, 1.32% loss. If it would have gone all the way down here to my emergency stop, I would have lost $1,000. So I mean, I lost a very, very small amount on that. If it closes back above the 250 next week, I can consider it again. So this one was a loss of 1.32%. All right, I think that is all on the weekly. We do have one monthly trade left, and this has been a wild one. This is Southwest Airlines. I did buy Southwest Airlines all the way back on January 31st, 2022. Why did I buy it? Well, here we go. Confluence of signals. We had a V2 entry, bar 1, bar 2, bar 3, bar 2 goes under bar 1's low, bar 3 closes above bar 1's close. We also had a rejection of the 100-day moving average. Now, whenever I enter a V1 or a V2, my end of day stop is closed below halfway of the washout bar, which is always the day 2 bar. So if I get a close below this $42 level, from a Fibonacci standpoint, from an equilibrium standpoint, it should hold the halfway on a closing basis. So 42 was my end of day stop, emergency stop down here, 2 ATRs. So I bought here at 44.74. Next week it went up, came back down, tested the halfway of that washout bar. Did I stay in it? I did, because it closed back above. Next week went way below that halfway, closed back above, so I kept it. This week also came down, tested halfway of that washout bar. So it shows you that halfway of that washout bar in V1s, V2s, important area. And again, go to my YouTube channel, look for the V1, V2 lesson in the lesson playlist and watch that. It'll give you a lot more information on V1s and V2s. All right, well, where are we at now? I bought here at 44.74. Currently it's 46.76. So currently this trade is up now about 4.19%. You can see I have the 3 profit targets. We went over that before. So if I had 100 shares of Southwest, if it got to my 1 ATR, I would sell 10. If it got to the second, I'd sell another 10, because that's 10% of what I had. Third, and then I have my trailing stop level up here. So monthly bars move very, very slow. I've had some of my biggest percentage gains on monthly bars, and that's another reason I like to trade monthly and weekly. So this particular trade up 4.19%. So those are, I guess we'll just do a quick little recap before we get on to trader psychology. Current open trade gold up 1.42%, and I also took half profits at 1.42%. Google had a losing trade, got out for a loss of 2.8%. Morgan Stanley got out for a gain of 1.32%. Facebook on the weekly down 2.73%. IWM on the weekly up 2.78%. IBB even, that's just a brand new trade. Disney a loss of 1.32%, and the monthly open trade on Southwest up 4.9%. So not really too bad. Not really too bad. So I talked about trading psychology earlier. Let's head over, take a look at this. This is from Mark Minervini on Twitter. Of course, Mark is a very famous trader, very famous educator, a market wizard, and I would really recommend that you read anything that Mark Minervini puts out on social media, on Twitter. You can follow Mark at Mark Minervini over on Twitter, and let's see what he has to say. Why do the majority of new traders fail to produce superior performance and quit? because it's true. Lots of traders just quit. Why do the majority of new traders fail to produce superior performance and quit? Because they are attracted to the idea of being a trader, the money, the glamour, and the excitement. But they're focusing on the money and the excitement and the glamour instead of what you really need to focus on, which is the discipline, the process, the sacrifice, the commitment and love of the craft. The devil's in the details, everyone. Majority of traders lose money. The people that are losing money are doing things they shouldn't do, and they're giving the money to all the people that are doing what they're supposed to do. Really, that's pretty much what it comes down to. And, to be a good trader, it's not just about risk to reward and setups. It's about lifestyle. It's about, possibly meditating, journaling, processing, thinking, sacrificing time to look at your chart, sacrificing to analyzing yourself. I mean, there is a lot to it, everyone. And if you want to be part of that 10%, 15% that makes money, you have to do what the other people are not doing. And that it is summed up perfectly here. You have to have discipline. You have to love the process. You have to sacrifice, and you have to be committed and love trading. So it's a whole ball of wax. It involves the entirety of your life. But if you're committed and you really want to be a successful trader, that's what you have to do. So one more time, why do the majority of new traders fail to produce superior performance and quit? Because they are attracted to the idea of being a trader, the money, the glamour, and the excitement instead of the discipline, the process, the sacrifice, the commitment, and love for the craft. This is a great post. Thank you, Mark. Appreciate that. Please go and follow Mark Minervini at Mark Minervini over on Twitter. All right. Now, before we start looking at the potential interesting setups for me for next week, I told you about my friend Frank. You can follow Frank over at FrancoD. Great poet, great musician, journalist, just great trader as well. And I love his poems. And let's take a look at this one. Today, a toast to traders. Here's to the market when it's just plain nuts, making no sense, no ifs, ands, or buts. To the market when it dishes out all kinds of stuff until frustrated traders shout, enough is enough. A salute to the traders who hang in tough. Isn't that a great poem? He does this every day. I mean, what a skill. My gosh, I think he was born with it. Toast today, a toast to traders. Here's to the market when it's just plain nuts. And it's plain nuts lately, right? Making no sense, no ifs, ands, or buts. To the market when it dishes out all kind of stuff until frustrated traders shout, enough is enough. A salute to the traders who hang in tough. And yeah, I salute all you traders that are following your process, hanging in tough. There's certain years where it's super easy to make money in the market. There's certain years where it's very difficult to make money. A lot more difficult right now, right? With all the things that are going on in the world. So I do salute everyone who's hanging in tough. And if you're not hanging in tough, start doing it. Position size, get out quickly when you're supposed to, be disciplined. That's really what it's about. And thank you, Frank. Please follow Frank at FrancoD over on Twitter. All right. So I did mention that I've already gone through my entire watch list. Just a little bit of a time saver, everyone. Hope this is okay, but I spent a lot of time going through charts that don't have setups. And I thought to myself, well, I think this is still good because it will show the viewers, that I'm waiting for this or that to happen. But regardless of what I'm looking at, I'm waiting for something basically to go higher or lower. So let's start off. These are daily trades, and I did mark 15 of these, and let's start off with Apple. All right. Well, looking at this chart, this reminded me, I did buy Apple back here on the 15th of March with a close under, close over the 200-day moving average. Great signal. Moved up, of course, beautifully just to close under, close over the 200-day moving average. End of day stop would have been a close below 200, but you can see this moved up beautifully. It got to 65 RSI and then closed below the 5 EMA, and that's when I got out. So I did get in about 155, got out about 174. Great trade, and you can see that was the right place to get out. You're like, okay, Greg, well, show us your really good trade. Well, the reason I'm showing you that is because it did reject the 200-day moving average last time. So because it rejected it last time, is it more probable that it will respect it this time? Yeah, I think so. I mean, look, we're at 165.29, 200-day moving average is all the way down at 158.10. But I would buy Apple if we got down to the 200. It doesn't look very likely, but you know, in this market, you never know. So I did want to point it out. I mean, it is down 4.23% today, but it could do that, right? It was down 3% just on Thursday. So yes, it is definitely possible that we could get to the 200-day moving average on Apple. And that's why I want to mark it, put it up here on this podcast, because yeah, I guarantee you, if Apple gets to the 200-day moving average, I will buy it again. If it slices right through it, I won't. Try to pick it up at the 250. Would love to buy Apple, the 200 or the 250. Don't know if it's going to get there. To the upside, we could get a 520 crossover. That looks unlikely at this point with the big down move. You never know, but just, I guess, to cover my bases here, if we did have a 520 crossover, I might be interested in buying that next week. Not sure. We do have earnings, big earnings coming up. Apple on the 28th. So keep that in mind, regardless of everything I show you here today. If I do enter something, I will get out I will get out when we have earnings, even if I'm in the trade one day before, right? A lot of times stocks will run up into earnings. But so if I get a valid signal, I will go ahead, hold it. But regardless whether I'm holding it 10 days, 2 days, 1 day, I will get out prior to earnings. So on Apple, it's a long shot, but it's possible. If it gets to the 200, I'll definitely be looking to buy, or the 250 for next week, I'll definitely be looking to buy. Advanced micro devices. Wow, semiconductors have just gone cratering down. Unbelievable. I mean, look, we were up at the 200-day moving average. We broke the 200-day moving average. We broke the 250. We broke the 300. I mean, we have sliced through major moving averages, the 200, 250, 300, like a hot knife going through butter. So where would I buy AMD? Well, it's gone through all the major levels. So those are not good and not, I mean, I guess it's possible we could go up, probably wait till earnings to do that. But we have earnings here on the 25th. Would I buy this? Or when would I buy this? I would buy AMD if we went under 30, over 30, in either an intraday rejection or a close under, close back over. So for next week, we are at 33.18. We certainly could get there Monday or Tuesday if we have a down market, but an under 30, over 30 is what interests me on AMD for next week. Again, if I take the trade, I will get out prior to the earnings coming out. Salesforce, CRM. We're at a 35.81 RSI. All the major moving averages above us. The reason this interests me here is right now we're at a 35.81. If we could go under 30, over 30, that would be a legitimate signal. And I can just tell by looking at this chart, the 30 RSI range is going to be right down here, close to the previous low. So that will be a nice confluence of ideally an under 30, over 30, under this previous low and back over an undercut. So that would be the confluence test of a previous low. At the same time, you have a confluence of an under 30, over 30. So that's what I'm looking for on Salesforce, on CRM. DIA. Well, we did lose the 300-day moving average here on DIA. This is the orange line, but it certainly could recover from that next week if we have an up move. Here's the 200, here's the 250. We're under both of those. Well, actually, we're under the 300 as well, but the 300 is a place right here where it looks likely for next week that if we do rally, we could close back above the 300-day moving average, and it does back test well. I have back tested it. So yeah, if we close back above the 300-day moving average and it gives me a good risk to reward ratio, I wouldn't buy it if it closed all the way up here because then it would be too chasey, but I want a good risk to reward ratio back above the 300. So it gives me support below. So next week, if we close above the 300 and it's a good risk to reward ratio, I'll be interested in that. GNRC. Well, here we go. GNRC is at a 3165 RSI level. You can see we've already tested this previous low back here on 128. We had a huge rally from there. Would I buy this right now yet? No, I would not. It's 3165. If it went under 30 and back over 30, that would be my entry signal. If it went back over the 30, under 30 and back over 30, most likely it would be back over this low. So that would be the confluence, under 30, over 30, and rejection of this previous low. So that is also on my list. Google. All right. Just had that losing trade on Google that we mentioned, the close under, close over the 300. But I'm not giving up on Google because we have different levels still. If it closes back above the 300 next week, look to buy it. If it goes under 30, over 30, I would look to buy it. So just because you have a losing trade once, don't get to the point where if you have a losing trade and you have a new legitimate signal that you don't want to get back in. I see that happen all the time. So most likely for me, if it goes lower and under 30, over 30, and a retest of this previous low, that would be outstanding, or just another close above the 300-day moving average. Intel, well, we're at 3863 RSI. Looking at the charts here, if we get down to this previous low next week, right here around $43, we will be in the low 30s or an under 30, over 30. Doesn't look likely, but it's possible. But I would buy Intel if we went under 30, over 30 in a retest of this previous low. Coffee, well, it has held support down here at the 200-day moving average. It never tested it, but if coffee next week were to come back down, test the 200-day moving average, give me a intraday rejection or a close under, close over, or a bounce, I would look at it and definitely would consider it. In addition, the 200-day moving average is lining up with the third ATR channel. Remember, 92% of prices hold at the negative third ATR channel. So that's just a decent place to look for an entry as regardless, right? But it also has a confluence of the 200-day moving average. So I would go ahead and be interested in taking a trade on JO if we rejected the 200-day moving average, or if we went even lower and tested the 250. MasterCard, nice little, this was a legitimate entry on MasterCard here, as a matter of fact. I didn't buy it, but it is legitimate with a close under, close over the 200-day moving average. Let me show you why that is. So this is etfreplay.com. I'm using this by permission, and I'm back testing this. Here it is, MA MasterCard 200-day moving average. Run the back test. And so basically, if it closes under and then back over the 200, you stay in the trade as long as you can, as long as it stays above the 200. If it closes below, you'll get out. But you can see, does it back test? Well, it does. Using that approach, staying in above the 200, going to cash under the 200, 626% return, not as good as buy and hold, which was 1549, but the drawdown was much less than buy and hold as well. But the main takeaway here is that it does back test well with the close over the 200, and this is a legitimate entry. I didn't buy it because I bought the monthly trade on IBB instead. But next week, if we do have another retest of the 200, where it goes under and closes back over, gives me a good risk reward ratio, that would be interesting for me. McDonald's, I would buy McDonald's if we pulled back to the 200, but only if we pulled back to the 200. It could just keep going up, but it did it did respond well last time it touched the 200, so McDonald's at the 200-day moving average. Microsoft, well, very interested in a company like Microsoft with the strength and the power that they have, but I need it to go higher or lower. I need it to either close above the 300-day moving average. Right now it's below, or go lower to the 300. So this is a good example of waiting for something to go higher and or lower. If it closes above the 300, that would be my spot. If it goes under, back over, if it heads down and goes under 30, over 30, that would be my spot. Nvidia, well, I was looking to buy Nvidia on Friday, and this is one of my very, very favorite setups. I was looking for an intraday rejection of the 300, but it closed below. If Nvidia closes back above the 300, I will definitely be buying it on its great company like Nvidia. Holy smokes. And a good risk to reward ratio at the 300. I mean, we're in unprecedented times here for semis. I mean, this has just come down. I mean, basically went close to the 70 RSI. We're close to the 30 RSI. So if it heads down lower, under 30, over 30, I would get in the trade. If it also closes above the 300, I would get in the trade. SPY, well, here we go. SPY, I really love this level here, the 300-day moving average level. So if we went under the 300, close back over, I would get in. If it goes higher and closes above the 250, that would also be an entry point. These do back test well on SPY, the 300, the 200, the 250. So right now it's kind of in that purgatory. It's stuck below the 250, stuck above the 300. I either need it to go above the 250 or I need it to go lower, reject the 300. UUP, I don't usually talk about short signals, but this is a good example here of something I'm looking to short. There's all sorts of bearish divergences here. Divergence means, you know, you have a high with a high reading, you go higher and you have a lower reading. Or in the bullish case, you go low and you have a high reading, you go lower, you have a lower reading. That shows that you're either running out of buyers, running out of sellers. Well, there's all sorts of divergences going on here on UUP. Let's start first with the MACD divergence. Here we have a high with very tall MACD bars, green MACD bars. We pull back to red. Now we're higher, right? You agree we're higher here than we are here? Well, look at the readings of the green bars here. Very shallow, not as high as over here, which means that MACD is a momentum indicator. It's showing you the momentum of something moving up. Well, it moved up strong here as indicated by the MACD bars here. This second leg up here has gone up, obviously, but on fewer red bars. So that's telling me that the buying here is running out of steam. Now that is called a MACD divergence. We also have an ATR divergence. At this prior high, we were above the 6th ATR channel. Now we're much higher. We're barely above the 3. So that's also a divergence. Look over here at RSI. Look at the reading of RSI over here. Very high RSI reading above the 70 RSI. Well, now we're higher, obviously, but look, we're not even above the 70 RSI. So I am looking for a short position on UUP based upon the big context here of the of all these bearish divergences. I'll be looking for a V1 to the downside, V2 to the downside, another possible rejection of the 70 RSI level. And so that's what I'm looking for on UUP, but nothing really specific here. You know, shorting is a little bit more technical, especially there's no key levels here, but the double tops with the bearish divergence, the ATR divergence, and the RSI divergence really are interesting to me, but I don't see a clear setup. I just wanted to point out these divergences, these bearish divergences to the upside. XLF, last one. 300-day moving average, it does back test well over the 300-day moving average. So it either, like many things on these watch lists here today, it either needs to go lower, under 30, over 30 RSI, or a close back over the 300-day moving average to the upside. So that's what I have. I have Apple with a potential pullback to the 200 or the 250 for next week. AMD looking for an under 30, over 30. CRM, also looking for an under 30, over 30. Dow Jones Industrial, just a close back over the 300-day moving average. GNC, looking for an under 30, over 30. Google, looking for an under 30, over 30, or a close back above the 300-day moving average. Intel, looking for an under 30, over 30. JO, looking for a rejection at the 200-day moving average and the negative 30 ATR channel. MasterCard, this is a legitimate trigger that happened on Thursday, looking for another retest with a good risk to reward ratio to give me another opportunity to get in there. McDonald's, pullback, retest of the 200 would be an excellent place to look for a good risk to reward ratio. Microsoft, either an under 30, over 30, or a close back over the 300. Nvidia, under 30, over 30, or a close back over the 300. S&P 500, rejection of the 300-day below or a close back over the 250 above. UUP. Just wanted to point out here the major bearish divergences. Probably not. I mean, I'm not recommending anyone take this trade. I'm not recommending anyone take any trade, but I just thought this was a good example of, I mean, this is one of the most bearish charts that I've seen in a long time. And then XLF under 30, over 30, or close back over the 300. So, as I mentioned before, when I do this podcast, I go through, I talk about V1s, V2s, intraday rejections, all this kind of stuff. And, I'm not, for my students that I have and people that have been following me do understand that. But, if you are interested in really learning this the right way, the best way to do that is to study one-on-one with me. I do have a course. It's 15 hours long. It's just you and I on Skype in the evening time, 5 sessions, each session's 3 hours. That gives us the 15 total hours. It's a great course. I've taught people from all over the world. I'm a good teacher. I teach really good setups. I teach you step by step. It's very, very important to me that my students succeed. And just got done with one of my latest students, David, who is an excellent student. David, if you're listening today, really congratulations, bud. I have no doubt you're going to do great. But, if you want to learn the skill of trading, just contact me, send me an email. The email is in the link of this YouTube video. I'll reply and say, hey, thanks for saying hi. Let's set up a Skype call. The Skype call is free. It's not a sales call. I just want to learn more about you, your trading, your trading challenges, your goals, what you want to get out of trading. It's a good time for you to ask me questions. And when we're done with the Skype call, think about it as long as you want. I will not contact you. You have to contact me. And, one day if you wake up and you say, okay, today's the day. I really want to learn this. I want to work with Greg. Just send me the email. We'll get it scheduled and away we'll go. The course costs $1,750, but for the one-on-one attention that you get and the content you're going to learn, I promise you it's worth every penny. All right. Number 2, I do have an online course available at udemy.com. It's a great course. I've got so many good reviews, feedback from all over the world. I teach you the deep dip buy stock trading approach. Not all 5 of the approaches that I use like I do in the one-on-one private lessons, but still a great approach. It teaches you about position sizing, profit targets, trailing stop levels, emergencies. And the best thing is it only costs between $12 and $15 on Udemy. It has a ton of content, 9.5 hours of video, 15 study guides, 26 videos total. It's a great course. If you're interested, it's affordable. You're going to learn a ton. It's a great place to start. And the link is in the Udemy. The link to the Udemy link is in the description of this YouTube video. And then lastly, if you like today's podcast, I really would appreciate it if you could hit the thumbs up button. It just helps to build the channel. It lets YouTube know that there's some valuable content here so they can get it out and share it. Appreciate all of the comments everyone's been making. If you have any questions, put them in the comment section. I'll do my best to get to them. But yeah, if you could hit the like button, if you could share it maybe on social media, it just helps everything keep going. And because there are a lot of people out there that need some good training when it comes to trading. There we go. All right. So I hope this was helpful today, everyone. I hope you enjoy the long weekend. Try to go out, do something nice for someone today. Really would make the world a better place. Go out, try to do something nice for an animal as well. If we all just did one nice thing for another human being, it would make the world a better place. If we all went out and did one nice kindness for an animal each day, it would make the world a better place. But if you could do one for the human, one for the animal, it would make it even a better place, right? It just makes sense. I mean, you like it when someone does something good, nice for you, or an act of kindness, right? So why wouldn't someone else like it if you did it? So just something small. Hold the door open for someone, give them a wave, help them out, just something. It's good karma, and it's going to make your life better. And like I said, I think one day someone will be there for you as well. So anyway, I hope this was helpful, everyone. If you have any comments, just put them in the comments section. But that's the watch list I have, and that's what I'll be looking for next week. So have a great rest of your week. Be good, be safe, study some charts, study some trading books, do some meditation work. But generally just have a good weekend, and I appreciate your time here, and we'll see you next week. Thanks a lot, everyone. Talk to you all soon. And on the way out here, I have to run the U.S. legal disclaimer. Thank you. Have a good weekend. Bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.